What's up, guys? It is Chaim Schramm of Chaim Investment Advisors. Last night, November 21st, we had a conversation about what to expect from the incoming Trump administration, from incoming Congress, policies, what it means for markets, etc. Folks wanted to hear about it, and folks also wanted it uploaded to YouTube so they can rewatch it for folks who missed it or folks who had no idea that it was happening and find us on YouTube. Hope that you enjoy. Thank you for listening. One thing I will say before we get into it is we talk about some relatively specific investments here. I've edited some of them out, but just a reminder, nothing in a podcast from me is investment advice. If you want investment advice, of course, that's my job, and you can get in touch via ChaimInvestmentAdvisors.com. Link in the video description. Thank you for listening. Take it away.
Okay, all right. I'll do a little intro. So our talk today is led by Chaim Schramm. He is an independent wealth management and fiduciary investment advisor based in Oregon, mainly specializing in hourly rate fiduciary investment management and financial planning. And he's been a planner since 2014 and worked in the art sector in Oregon and in New York City before becoming an advisor. And so take it away, Chaim.
All right. Today we are talking markets, election outcomes. I've had a lot of requests for this. So yes, many people will be tuning in today and also tuning in YouTube later. So a lot to talk about. I'm going to try to, hit all of the really important stuff that people actually want to know. That is actual policies. What do they actually mean for the three big categories, the stocks, the bonds, and the other things? And what do you do with that as an investor? I'll talk about that. And I'm going to spend the briefest time possible acknowledging that things can actually go really bad and worse than we're talking about now, because we're actually not going to spend a ton of time doom and gloom. We're mostly going to talk about things as if they are like in the normal range of civilization. But of course, that could not be true. We just don't know. We'll start by talking about policies. And there's three big. If Trump is an iceberg, that's the Trump administration, we are on the absolute zenith of the iceberg today of all of Trump universe. We're just going to talk about the policies, not any of like the social policies, to put it lightly. We're talking taxes, regulation, trade, these three categories that are easy enough to understand and been kind of telegraphed like what to expect, both from last time around and also this campaign. And first one to talk about is the one that is going to make most people in this meeting and also elsewhere happiest. And that is talking about taxes. Because taxes, at the end of the day, the tax reforms that are likely to happen, and we'll see a little cheat sheet of how can things happen, by what means do things happen in a minute. Tax policy is the one that most people like. There was a major tax reform that many people have simply forgotten happened because it's now everybody's done their taxes for years. It's been the same game. But the TCJA, which was the big tax reform for 2017, really, it's a mixed bag of things that end up being popular left and right. And that's partly because, unlike previous Republican administrations, this is a populist version of a conservative tax agenda. And it does some things that people who are left-wing populists like too, which is small business taxation. It's more competitive with corporations. A lot of people like that. The standard deduction for middle class and lower class working class folks. It makes it so that the tax burden on that segment is notably lower. And the estate tax exemption, which is really high, basically is popular because almost nobody except really rich people have to worry about federal estate taxes like they used to. And all those things, they're likely to happen. And those are the big tax reforms to expect. There's a proposal for a 1% corporate tax cut that is less likely to happen. This one, or at least most of it, is likely to come back. It's popular. And so this one is probably has the least like troubling impacts on the economy. Most of them are presumably good, even for uh, speaking about inequality in America is something I like to talk about a lot. Most of you have heard it from me before. That's a top concern. This is the area that's the least concerning, even though, yes, it makes really rich people richer, which is just going to happen anytime you got Republicans. Uh, and regulation is one of those buzz terms that if you like tune into Bloomberg often or you read Wall Street Journal, you're going to hear a lot about deregulation is one thing to expect. And it's kind of a buzzword, it's kind of a meme. The fact is, most corporations that are in business and making money right now, they pretty much are used to the regulatory framework. We don't really have a whole lot of changes that are going to happen for your average company, good or bad. And that wasn't going to happen either way. And at the end of the day, the president is not the person who makes regulatory policies. Really, I mean, he makes a couple, but it ends up being mostly agencies that are doing this. So expect a little bit of change. Financial regulation is a mixed bag. A lot of times people are used to this investing playbook where people say, oh, you've got a Republican administration, banks are going to be deregulated. And the reality is that the populist wing of the GOP that's there right now is actually less specifically Wall Street and banking friendly than, 10, 20 years ago. It is actually somewhat antagonistic towards Wall Street. And so we really don't expect that the massive banking deregulation we had, with George W. Bush, et cetera. Cryptocurrency is this weird thing that Donald Trump has embraced in ways that are hard to understand and for me. Yeah, don't really know what to expect. We do know to expect some shakeup at regulatory oversight of the cryptocurrency world, but we don't know what that actually means because we don't know who gets put in there and what do they do. Uh, that's the one channel that we could probably expect that to really happen. Also, mergers and acquisitions is another kind of buzzword that you'll hear a lot about. Uh, the reality is that mergers and acquisitions are not happening at lightning pace right now because interest rates are high. He wants to shorten the amount of time it takes for the average thing to go through, and that is something that's going to happen. M&A, deregulation, expect a little, not probably a lot to come of it in the next couple of years. And trade is the other pretty big one that you're going to hear a lot about. And trade is the thing that is most likely to happen, as we're about to see on the little graph of how does Trump make these things a reality. This is the one he can just like make decrees about effectively to an extent. And right now, for context, 25% tariff exists right now. That never actually went away from first round Trump. You've probably heard the headline that he wants 60% tariffs on China. And there's a lot of fine print on that because it is not likely to be 60% on everything ever. It's probably going to be on this category, analysts believe. It's going to be on what we call intermediate goods, which is financial leads. And it means things that are semi-finished goods. So not like totally raw materials, but things like steel and aluminum, things that get used to produce even more finished goods. And that's the one he's had the most success with. It's the one the GOP likes to tariff long before Trump. So that's the stuff that's most likely to get done without a lot of controversy. But yeah, this is the most likely of all the three things we just talked about to happen fast. I don't know if there were any questions, Maya, that I should pause for or anything like that, but
Not so
sadly I
far.
can't.
Yeah.
Yeah, cool. Sadly, I can't manage the chat as well as I sometimes can with the current format. And this is a graph of which of these things is likely to happen. Uh, and this is how the means he accomplishes these things with. So you'll notice a lot of the stuff that is trade related, he can just do. It's an executive action. That's all the trade stuff with China. Also, the tariffs he wants to do against our actual allies. A few years ago, it was actually about 7 years ago, wrote an article for a policy journal called uh, Trade Wars Against Allies Are uh, Uncommon and Bad, or some version of that. And so I wrote about this long ago. It's still a thing. It's still controversial. It's the thing that's most likely to get blocked by the GOP, is the EU, tariffs against the EU in countries that are actually allies of America. They are not normal. And a lot of this stuff requires legislative action. And the GOP in the House has currently a 2-seat majority, which is not much. And so a lot of this more controversial stuff is probably not going to happen. And like I said, some tax stuff is likely to go through. But this is kind of the stuff we should expect quick action in the first 2 years on. Basically, it's going to happen pretty fast. And there'll be a lot in the news about it. And it'll shake markets up quite a bit. They're right now kind of trying to price in exactly this range of expected policies. And so, what does that mean for different segments of markets? We'll talk about stocks first because that's the one everybody asks me about every day. What's going to happen to the stock market? And stocks last time with Trump did very well across the board. They did a little bit more than average in some categories. In some categories, more average. And this time, the market's been initially very excited. The market was up a few percentage points the first couple of days after the election. And there is a little bit of a different situation for the stock market than last time. So it's not going to be exactly like last time. This time, stocks are starting out extraordinarily expensive. And when I say expensive, what I'm talking about is asking the question, how many dollars are you paying for every $1 of earnings companies actually have in the portfolio you're buying or the stock you're buying? There's this handy tool on the right side, this graph called the cyclically adjusted price earnings ratio, CAPE. It just means how many dollars, when you adjust for inflation and other cyclical factors, are you actually paying for your portfolio? And we are at 37.74, $37.74 today. That is pretty dang high. It compares not favorably to the dot-com bubble burst, which is that really big spike that you see before. And the last time we got, not that long ago, to that level, the stock market crashed 20%. Uh, so it's expensive, and we'll see a chart later of what happens over bigger time frames when you start out like this, and it is not good. So this is a bit of a lid, so to speak, on how excited about Trump can markets get. Well, this is a limiting factor for certain. Uh, with that said, last time around, and probably this time too, uh, tech stocks, we're going to see just how well they did in a second. It was really good. Uh, Large companies outperform small companies. Expensive companies outperform cheap companies. That has been uh, a phenomenon of the Trump world, and it's probably going to happen again. And really profitable companies outperformed not profitable companies. And that is, in terms of what do you do with this information, probably the single most important thing that I could tell you is profitable over not profitable is something to consider very strongly as an antidote as well to some of the problems posed by really expensive stock markets. This time around, unlike last time, the middle sized stocks are expected to perform really well. These are companies that are not small, but they're maybe not the level of household name. So there are in America something like 700 of those companies that are at that size right now, and they make really interesting place to get position in terms of stocks. And this is a chart of exactly what happened last time. And it is probably going to look like Greek to a lot of people. And basically, the thing to know is the line that's really high was tech stocks. That was what we call the NASDAQ index. It blew everything else out by a pretty big margin. And more than doubled the return of the rest of the stock market. The S&P 500 index of stocks underperformed by a pretty staggering margin last time around. What is not shown on the chart is that it plummeted 30% in the course of 3 months, exactly after this, over the next 3 months of the next year. So it's a little bit of a framing problem with this chart. But this is exactly when Trump was president. This is what it looked like. The thing that did really bad is this thing called XLRV. That is a real estate company index. And many people kind of presume, and rightly so, that Trump favors real estate. He's the real estate guy. But publicly traded real estate that goes to the market as this kind of structure actually did really badly. It barely made any money. Over the course of 4 years, it made 15%, which is uncommonly low. Usually, this segment keeps pace with the rest of the stock market. So it got, even before 2020, before we had, pandemic, it also didn't do that well. It was underperforming for years on end at that point. And small companies also underperformed the S&P 500. They're that 76% that's right under the S&P 500. And that is surprising because they usually, over big time frames, actually make more money than the S&P 500, which is why anybody buys them, because they're more volatile. And so this is some of what to expect this next time. Like I say, the middle zone, though, I do think there's a really strong argument for thinking about that, especially if you just equal weight it. You don't try to pick which of these is going to win or lose. You just say the whole 1,000 largest companies, give them an equal weight. There's great indexes. Invesco is probably my favorite that do that. And they actually should do really well. And a little bit, just the briefest amount about macroeconomics. It is a reality check on Trump rhetoric versus Trump reality from last time. Trump came out the gate antagonizing Mexico, and in reality, Mexico benefited the most from our trade wars with China. It was the number one beneficiary of our trade war with China. And this next time, that's also likely to be the case, even as it is the boogeyman of Trump persistently. Also, India did very well last time, expected to do kind of middle good this time. Vietnam did fantastically last time. Cambodia did as well. This time, Japan is already, before the elections happened, picking up a lot of slack from the Chinese economy that is already not good. So already in bad shape. And Japan has done very well the last couple of years. So I expect that to continue to happen, usually for a long time. If you listen to me for a long time, there's a lot that bummed me out about the Japanese economy that no longer bums me out, frankly. And it's definitely something to get intrigued by. Bond market, what to expect from bonds. Corporate bonds outperformed treasury bonds. And this time, that's going to happen at a faster pace. The bond market, most people know treasury bonds because it's the biggest bond market in the world. It's the US dollar. They just invent dollars to pay back their debts. And so they're presumed to be a great investment. But an issue with treasury bonds is that everything that Donald Trump wants to do creates inflation. Like every single policy he wants to do is going to create inflation, from taxes to tariffs to uh, you name it, basically. And all of that is bad for treasuries. It makes just regular vanilla dollars better, and it makes treasury bond investments less good. Uh, and corporate bonds last time around outperformed treasuries by a pretty staggering margin, by double, which, bonds, these are both very boring bonds in terms of how volatile are you getting, what are you expecting out of them. To see twice the performance was really interesting at the time. And that's expected this time around too. This thing, the middle line, the big gray area, is just the entire bond market's performance. The lowest line on this chart is treasury bonds. They did really badly last time. They had some serious problems during Trump, and this time it's expected to worsen because, uh, yeah, the problems with the dollar and our treasury bonds are probably going to get a lot worse with the more extreme versions of old policies Trump wants to do this time around. And so, to me, corporate bonds actually are really interesting. Whether both of these lines up here, the top one is the riskier bonds. The bottom one, that is very, very similar in return from last time around, was the highest quality bonds, where you're taking the least risk from corporations. And if you don't know that segment well, think about basically the Microsofts and the Apples of the world. That's who is investment grade. Those are pretty safe investments this time around. So if you're freaked out by how expensive stocks are, then you're paying attention, which is good. And corporate bonds are a great place to dig around for something to diversify into that should do a lot better than just regular old treasury bonds. And that is something I am focused on as a portfolio manager over the next few years. This is a pretty technical topic, probably for almost everybody who's watching this. So I'm not going to harp on this too much. This is the yield curve. Some of you have heard me talk about the yield curve ad nauseum already, but yield curve is how much do you get paid for every measure of risk on in time that you're taking. So a whole array of different intervals of treasury bonds you could buy. How much do you get paid on every point of it? That's the curve. Usually you should get paid more for a 30-year bond than a 30-day bond. And that is not true. Right now, you get paid to take the least amount of risk, and that is bad. It's already bad. And Trump starts out with a recession signaling yield curve. This both signals and creates recessions when it looks like this. So that's what to expect is that a couple of years out, markets are pricing in, possibility of a recession, very real. And the weird thing for this curve and Donald Trump that will be a stumbling block to doing a lot of things he wants to do is that the tariffs, especially that he wants to do, which he's likely to do, we just talked about, they create higher inflation. And higher inflation makes bond yield goes up. It makes the yield curve look worse, basically. And so he is up against the fact that the shape of the curve is probably going to look bad this whole time. And things like mortgages that people have been like hoping, the mortgage rate's going to come down. People are going to start buying houses. They're actually going to go up, and they have been going up ever since the election happened. And I expect that to keep going up. There's actually a few indexes where you can keep track of what are people pricing into the future, and it's going up pretty rapidly at this moment. So higher interest rates, not lower ones, is potentially a problem for all of us, especially if you were buying or selling a house. Maybe you're thinking about that. There is an inclination with a lot of investors, especially investors who lean left or bumped out by Trump, and frankly, that's like pretty much everyone here. They want to go into alternatives, not stocks, not bonds. And alternatives already is kind of it's a really weird landscape of things that are uh, out of the box ideas. So bank loans, private credit, the private equity stuff that's not traded. Uh, Real estate, of course, is kind of the core alternative. Utility stocks, there are also all of these trading strategies that get called alternatives. And all of them do badly with high interest rates and high inflation, which is what we expect over the next few years. So alternatives are not really a place to hide. If you're really worried about where stocks were at the start of Trump, this isn't necessarily the place to run to. Alternatives usually perform uniquely poorly during environments just like where we're at right now. And gold and silver sometimes makes people say feel secure, and I'm certainly a fan of gold and silver. I own both of them quite a bit, but in reality, everything Trump wants to do this time around actually makes them look pretty bad. If the dollar is getting stronger because inflation rates are going up and things are running really hot, in reality, gold does really poorly. Also, most of the world's gold demand comes out of China, and so weak China is weak gold. Uh, Gold price is not expected to do well, and the same stands for silver in its especially industrial uses. If China's not doing well, silver also does not do particularly well most of the time. And so those are not places to hide, which I usually like. Usually I'm telling people to get into those, but right now, actually pulling back from that, which is surprises a lot of people, especially because it just seems like a Donald Trump would benefit a thing like gold, but he doesn't. It's actually bad. And so strategies. What do you do with all of this information? I will start with the what not to do, and the what not to do will bum some people out too, because it a lot of people hit me up and they say, "Hi, should I just just take everything out of the market and just hang out in cash and let that be that?" Uh, in reality, it is actually one of the least optimal things you can do with your money. And the chart here, they have the gray pie charts. It shows that pretty starkly that the best way to lose money is avoid the stock market, well, especially during a Republican administration first year. Uh, Republican administrations, people have it in their heads that markets perform best when they're in charge, and it's not true. It's true the year of an election. Actually, the red bar on this chart that I have up here on the left side during the election year, yes, they do actually uh, put in higher performance. But in the longer run, actually, they fall pretty short of the average Democratic administration. So really, year one is the time to not miss on what's going on with Republican administration and stock markets. It's the time to begin, and really, it's a couple years in, usually during midterm elections, that things start to get dicey and come off the rails for GOP administrations. And I think that's especially true of Trump and the economy. From last time, it happened pretty intensely, and expect pretty much the same thing. So that's not a great answer. Is hanging out and avoiding markets, because frankly, right now they're in the euphoria mode. This is like when they're still happy. None of the policies have happened. Everybody's excited. Uh, yeah, maybe later is time to think about that, but also what not to do. On the other side of the coin, there are some people, even who are real left, that have hit me up, and they are doing what we call panic buying, even though it feels bad, and perhaps because it feels bad that the election happened the way it did. They want to buy the stock market because they frantically believe everything's going to go up and American life is going to get much worse, and this is kind of the one ticket out or something like that. Like I said at the beginning, so I shared the top right chart at the very beginning. How expensive are stocks right now? When the stock market starts out expensive, the whole next decade, they do bad. And so loading up on stocks too much is definitely, they're not risky. And in reality, they're probably going to put in worse performance than we're all used to. And they have every other time that they start out this expensive. But for the most part, they come in with pretty low returns. And right now, we are in the pretty expensive. Actually, since this chart was made just a few weeks ago, it's even more expensive. So the current cape is actually in the wrong place. It's even worse. So this is the other side of the coin. Is a lot of people will be hyping you up to like only buy stocks, and really it's the wrong answer. U.S. stocks are not necessarily the only thing to do, and it pays to pay attention to what kind of stocks you're buying. Like we just saw last time, certain stocks do better than others. So, in what do you do terms, international, very interesting international stocks, that is. Short term corporate bonds are especially interesting this time around, and profitable stocks with growth, which is going to actually freak some people out because they've never heard me say it before, even if you've listened to me talk a lot before. It is a little bit of a different playbook. And so, international, important place to pay attention to. The biggest beneficiaries, like we just said, of Trump's previous trade war shenanigans were all emerging market Asian countries. And emerging market Asian countries likely stand to gain. Mexico also is a chief leader of emerging market indexes in terms of its weight, in terms of the number of firms. And emerging markets, definitely not something to ignore. One strategy, if you're really, really freaked out about China and you're worried the worst will happen in terms of trade war activities from Trump against China, is there are indexes and many different active portfolios too that invest across every other emerging market country. So they are emerging market X, excluding China. That's one option that some people find some appeal in. It's not actually my favorite. My favorite is using profitability weighting of indexes. So instead of just markets, price weighting, saying, let's weight the profit of the companies at least to an extent, like give extra points to really profitable firms. There are a bunch of index funds from Atlantis and from Dimensional Fund Advisors and Invesco that do this. And when you do that to emerging markets, Chinese stocks are a much smaller slice of portfolios, simply because Chinese stocks may be really expensive and don't make that much money in terms of profitability. You get a much lower exposure to Chinese firms. And you get a lot more exposure to Taiwan, which also was a beneficiary last time around. And developed markets also should not get ignored by really any investor at this point. That is Western Europe, Canada, our second largest trade partner, and Northern Europe, Japan. That's the main ones, Australia too. That's something to check out on this chart that I included here. US large companies right now, so this is from State Street Global Advisors, their capital market assumptions they just sent out after the elections. They expect U.S. big companies, the S&P 500, we're all used to making 10%, to clock in at 6%. And developed markets to come in also not thrillingly high, but 6.7%. So outperforming our market, and emerging markets are really the big winner, expected to be over the next few years. And a lot of that has to do with just that chart we saw where our stuff's really expensive. Emerging markets are so cheap that they are actually pretty exciting. So they are a place to check out too. And other strategies, short-term corporate bonds. Corporate bonds, if you're tuning in earlier, we talked about corporate bonds being an intriguing place to look. In reality, really long-term corporate bonds are probably not the place to look for any kind of diversification or making any money. Reason being, if this wild stuff with tariffs and whatever happens, inflation is going to go up, interest rates could go up, and that really long end of the curve could get, it could be in really bad shape. It could lose money. And so getting into corporate bonds, good. Getting into really long, probably bad. Getting into shorter, though, actually looks like a pretty good way to be positioned over the next few years, even though usually, short-term bonds are pretty boring. They really are not exciting, even corporate ones that pay higher interest rates than some of the more vanilla treasury bonds, etc. And so that's something to check out, even though, nobody's, very excited to talk about corporate bonds. It's an important piece. And profit and growth, which usually, if folks have heard me talk about profitability and companies and profitability indexing, so creating indexes or weighting indexes by how much money companies actually make. Usually we're talking about combining that with cheap stocks value. That's been a pretty tried and true strategy. It's, the Warren Buffetts of the world. It's been their whole shtick forever. And usually it's also been my shtick. But these days we have to acknowledge growth, which means expensive. Frankly, it's a euphemism. The growthy stocks, the expensive stocks, probably do pretty well relatively under Trump. They did last time. They probably will this time. But low profit, expensive stocks will do badly. And so it pays to combine these two ideas. There are portfolios that do it for you. There's combined strategies. I probably am inclined to do combined strategies, and folks who work with me already, they'll probably be hearing a lot about this concept. But this is probably the number one in terms of just making money in U.S. markets. The place to be is high profit, but also expensive. You've never heard me say it before, probably, but it's what I expect over the next few years. And with that setup of really expensive overall market, the stocks that don't make money right now are actually really high risk. They're always risky, but they are extraordinarily high risk at a time like this. And we saw it in the dot-com bubble burst, like we just saw. We're not actually that far away from that level of prices right now. And I will spend the least possible time talking about this, but folks want to hear it or they've heard it. They, listen to other podcasts or whatever. Yeah, a lot can go wrong under Donald Trump. So we just have to acknowledge there's no way to ignore the fact that if the absolutely wildest fantasies of deporting people, immigration policies get implemented, the results could be quite bad, not just for the economy. I don't actually just want to frame that as a purely economic issue. I mean, we can use words like, oh, it'll induce inflation. I was listening to a Goldman Sachs analyst podcast this week where they kept saying that, oh, if it deports people, will be inflation inducing. It felt wrong because it's technically accurate, but incredibly incomplete for how terrifying that is for society. But definitely, you can throw a massive wrench in everything we just said. Everything, if the worst happens, could not look like what we just talked about. And it's important to acknowledge, and also, in reality, a realistic, assessment of who is Trump as a politician. Well, he's very much what we call the paranoid style in politics, which is one of different political styles you could have. But if you've ever listened to the guy talk, this is true. Also nationalist, also authoritarian, volatile populist base. Who knows what really weird out of left field or right field stuff can happen politically and economically. Some of the stuff you hear from the Freedom Caucus people in Congress, it's just not stuff you hear from normal political parties in American life. So who knows? There's extra unknown factors with this administration. The first 2 years that we haven't had to talk about in a while. So we're definitely keeping an eye on that, not spending all of our time thinking about it, but we are paying attention. And that's the end of the spiel portion. And so usually what I do is people unmute themselves and talk, but in reality, we're doing this recorded and it'll end up on YouTube. And if people want to ask questions, they absolutely can, or they have comments in the chat, because for compliance reasons with the regulators. We don't actually want people on camera. So yeah, people are more than welcome to type stuff. And you can also email me, of course, if you would like even more privacy than that. But yeah, open up to anybody who wants to talk and comment.
I will be checking chat too for a minute. If you want to send it to me directly or to the group,
Yes.
I don't think anything directly, but I can't see those. But we'll give people a minute to think if they have any questions.
Yes.
All right,
Nice.
I got one here.
Oh, great.
You caution people against panic buying.
Yes.
When are really high right now. So is
Yes.
there a length of time to buy or implement that you think is more optimal when you're putting funds in the market? If you want to get in, but you're not trying to just overdo it.
Right. I mean, uh, time diversification is always it's an evergreen strategy, and time diversification is the financially word for buying at different prices. It's one way to diversify that gets you the same amount of stocks, but over a bigger time frame. It's definitely something to think about. I hesitate to say for everybody they must do this because the market does rush to price in high expectations for GOP candidates. Seen it before. We're seeing it right now with Trump. So time diversification is always on the table. Consider, how you would feel if the market went really crazy for 1 year and it did bad all the other years. That's one thing. I tend to think of like people panic buy the most expensive stuff, and it's usually wrong. So, like, if you're really like you gotta get money in markets and get it doing something, I think if I'm panic buying, like I'm loading up on international and cheap stuff that's like right now going down in price. International developed is actually down since Trump got elected, even as it's expected by pretty much every analyst to do the best over the next 5 years. So that's actually probably where I'm going. It's like if I'm just like dying to buy something, it's there.
Thank you. Okay, I've got another one in the chat here.
Yes.
Are there any activist measures we can do or take during with investments to curb Trump's harm to key populations, communities, blue states, et cetera? Any way to leverage our buying power against his policies?
Right. I mean, this is one of the weird things about Trump's effect on Wall Street is that Trump just getting elected has already made Vanguard the second largest asset manager in the world back away from the stuff that it already did that was green and socially responsible and activist. So it actually immediately started backing away from the stuff that it already did. So people are kind of like afraid. I mean, to me, that signals they're afraid that there is some kind of like populist wave. I tend to think ESG is a great format in general for most of these things. ESG, probably the place that I trust the most to actually get out and vote your shares in your interests most often are places like Invesco and Pimco. They're ESG platforms, Nuveen, Avantis, dimensional funds. They all have more, a higher track record in actually voting proxies the way that you want to. BlackRock, which is the big brand in ESG and every flavor of socially responsible, really actually has a kind of a mixed results on its track record. So I'm keeping a close eye, and I haven't had a chance to talk to their ESG specialists since the elections, but that's kind of my number one question for them is any change like Vanguard did in stance on actually voting the way that your people want you to from Nuveen, etc., those other places I named, they're pretty much staying the course. So I like all the ones that I just named in terms of uh, their ESG funds actually doing what they promised to do. So, yeah, that is one way to think about that.
All right. Okay, I got another one in the chat for you. Says, if we're planning on buying a house in the next 6 to 8 months or a home,
Right,
uh, where is a low risk place to keep funds? Vanguard offers a settlement fund at 4.59%,
right.
but it's a better place to keep it that's safe.
Right. I mean, since we're transacting, if you're buying in the US, we're transacting in dollars. Those, like we saw with that yield curve, if you were tuned in for the conversation of the yield curve stuff, the yield curve points you exactly to where you make the most money. So that's one thing to keep in mind. One thing that overlaps well with the goals of a near term home shopper is you make the most money on the short end of the curve. So to me, things like that Vanguard, settlement funds, they're excellent options. Things like pretty much any high yield savings account. Also, if you are in a high tax bracket, definitely don't overlook the muni money market funds. Even I forget the ticker symbol of Vanguard's muni money market fund, but I believe that they have one. T. Rowe Price has one as well that you can buy from places like Vanguard. Fidelity has many of them that are state specific. So for some people, that's actually another layer uh, to add as well. For folks who are not, in that 24% bracket or whatever, maybe that doesn't matter. But uh, that's also stuff to think about.
Okay, we'll give people a minute. If they think of any questions, drop them in the chat, send them to me, and we'll keep an eye on it for them.
Oh, also, I got one.
Oh, okay. What's your question? Huh.
Discuss crypto. Yes, did we discuss crypto? I mean, we did talk about crypto, and basically the thing to know. Let's see if I can just pull it up on the fly once again, just so that we are looking at the same thing. Yes, here we go. And Maya, can you see that? Excellent. And Maya, also for people who don't know, Maya's my wife. So,
Yeah.
yes, she's been around for a long time. But yes, crypto is the one place of when people talk about like deregulation, we expect from Trump. Crypto is probably the one that we're talking about because, like we said early on, for folks who missed it, uh, populist GOP, the Freedom Caucus in the House, for example, they actually don't like deregulating Wall Street banks. That's not their thing, and their constituents hate it. Like their constituents get really pissed off if they go and it basically gives the big banks a break. It's really deregulation in crypto of all the deregulation that's going to happen in finance, it's probably the one that's going to happen early on and fastest and most substantively. And so M&A deregulation, that was the other one we kind of briefly talked about. That one's pretty nebulous to a lot of people, and it doesn't probably impact crypto that much. But really, I do think everybody should expect that cryptocurrency, if you're looking at cryptocurrencies like Ripple or Solana or other cryptocurrencies that regulatory authorities have wanted to say, look, these things are securities, really. They have a yield, uh, they promise investment performance, yada. Those ones that have had kind of a cloud of regulatory doom hanging over them might see that lifted. And nobody should be surprised to see Solana hitting all-time highs with what's going on. And I expect that to continue if Trump puts some personnel in the SEC that is less antagonistic of crypto, which I think is likely to happen. Probably, yeah, those things that have been in this gray zone that, Avalanche is another one, Aptos. a bunch of these that have yield associated with them, or maybe kind of like investments. Those ones are probably going to do particularly well because a lot of the stuff that the meme coins and the stuff that doesn't have a lot of utility, it never really was a particularly high risk from regulation. They Regulators have kind of not known what to do with them and they don't want to touch it. But those ones that fall into the zone of like, this probably passes some kind of test of it being like a stock or a bond. Those ones are probably the ones to look to like see some outperformance from. Also, excellent. So I don't know, Maya, if you got any
Oh, you're getting the DMs.
questions.
Way it works. Yeah, it's all good.
Okay, so I have another one to me about uh, reality of a Bitcoin reserve. Is this realistic? I mean, I think he likes the idea because he talks to uh, a lot of the folks who also are kind of like right wing populist leaders in other countries where they actually have done some flavor of this, or some mayors have wanted to dabble in this that are certainly in the Trump universe. So I think he likes the idea. In reality, I think he would actually try to make it happen, but it falls into the territory of uh, requires legislative action. Like if we look at that chart, really some version of that probably has to actually get some kind of legislative oomph, and that I'm not uh, very concerned about. Actually, it would be really volatile and wild, and I guess good for Bitcoin if it happened though.
All right, I've got another one for you. What'll be the next best thing to invest in knowing how the election went?
I think profitable stocks that are expensive are the most interesting thing. That's to me, if I'm going out and shopping for anything, which of course I am. So that's probably the thing and the time I invested the most in. And profitable, we're not talking, when I say profitable, that term to some people is also kind of vague or not very actionable. Profitable, we're talking about companies, not necessarily their earnings, but factors like accruals. So, accruals ratio is one of the big ones, return on equity. That's another one. And the other one is leverage ratio. And if you were really into to reading up on that topic, there's this guy, Novi Marks, who years ago proved pretty conclusively that profitable stocks just in any given year outperform the market. Uh, it's He came up with those three as the most reliable indicators of what is profitable. Is of course accountants try to make everything look profitable. Uh, they're all trying to attract dollars, etc. But those are three ways to look at it, and there are a bunch of indexes out there that use profitability. Some use this jargon word quality. You'll see that quality stocks. Quality, if you know bonds, it means one thing. Quality with stocks means how profitable are the companies. So that's another kind of buzzword to know, jargon word to be aware of if you're like hunting for stuff to buy. Quality stocks, definitely profitable, especially once they're expensive. Intriguing. Right. So I have a question. Do you have any word, Maya?
Not at the moment. You go for it.
I got one about overweighting small firms and mid caps, or yeah, basically kind of that middle zone. And I will reel back to an early chart here. Last time around, small caps actually kind of had a unique time of underperformance during Trump 1.0. We'll call it. So on this chart, the thing that says 76.71 on the right hand, that's just a little bit below the main gray bar. The main gray bar is the S&P 500. Small caps, early on, they were excited about Trump. They actually started underperforming even before the pandemic happened. And this time around, the reason to be a little less excited about small caps than I usually am, usually, if you know my spiel, I love small caps. I'm nervous about small caps because interest rates and inflation going up are bad for small caps. They're not always bad for the biggest companies. The biggest companies, it isn't necessarily a bad thing, as we saw during the first Trump administration. This QQQ, the top line, did fantastically well versus everything else. So firms that can borrow lots of money, uh, they tend to do well during Trump times. Firms that they borrow expensively in smaller amounts, the small caps, to finance their activities. I am a little bit more nervous than I usually am about, but the mid cap stocks. Actually, in certain, I don't have a chart of it sadly this time, but they actually have higher expected returns since the election from people who made capital market assumption tables than small. So mid, that OMFL ticker, for example, which is a Russell 1000 index fund, actually expect good things from. And personally, I own that one and like it very well. So that one I am optimistic about. Yeah, but the smallest of the small, I'm a little bit nervous about. Excellent.
All right. If anybody else has a question, drop it in the DMs of the chat and we'll give you guys a minute. Again.
And like I said earlier, if people have questions that they want to ask in a email format, of course, you're welcome to do that. And yeah.
I'm also going to take this moment to drop contact information like your Instagram and stuff into the chat.
Yes,
I will do that.
Thank you, Maya.
We've got a YouTube channel. We've got an Instagram and a website and email address. So there you go if you're looking for that information.
Right, and this will be on YouTube, so that's where you'll find it. Unfortunately, named channel in terms of like being inscrutable. But that's where it is. Cool. And yeah, if people don't have questions, that's also all right, because it is Maia Dart's 15th anniversary
today, of our first date.
Of our first date. So
when you don't get married for 5 years, you get 2 anniversaries. And you keep them forever.
Yes.
Yeah, but it's 15 years today. So that's great. So yeah, we're gonna have dinner. But any other questions, we're here for you guys. Oh, thanks. Congrats. Nice.
Yes, mazel tov to us. So yes, well, surely this will spark lots of other conversations, and I'm here for it. It's my job. So yes. Thanks for everybody being here and listening to me talk for a long time. Usually, you know that most of these things don't end up being as like me ranting. That's what it feels like. But usually I have people unmuting themselves. But since so many people wanted it, it was a 3-figure amount of people wanted to be on YouTube. So it's going on YouTube. That's why they did it this way. But thank you for listening to me for a long time and appreciate you all. Look forward to talking to all of you. And yeah.